Hello, good morning. It's Thursday the 8th. I'm FxPlew. There's a break in the rain, so I'm out on foot for the market brief. So Governor Bailey's been on. He made his quarterly report to MPs yesterday, and he said there's nothing that the Bank of England can do to prevent the country slipping into recession in Q4 this year. And he forecast no economic growth in 2023. He claims the monetary policy decisions have not created this crisis, but rather nasty Putin's invasion of Ukraine has driven up foodstuff prices and messed around with the energy supply. So that's teacher told, and he'll probably avoid detention. But while the UK isn't as dependent on Russian gas as Germany, for example, the economy is still energy dependent. So we are exposed to the higher costs, and to be fair, Bailey does have a point. Truss stepped up for her first Prime Minister's questions yesterday. She confirmed that hope would be provided for both domestic and commercial energy consumers. The energy price cap is likely to be frozen at around $2,500 for the next 18 months, but so far very little has been said about the business exposure to these higher costs. And that's as a report from the Federation of Small Businesses put about 53,000 UK firms at risk of failure due to the rising energy bills. Sterling had a pretty choppy day yesterday. We dropped to 114.05 against the dollar. That's a level not seen in more than 20 years. But it was like the market got a memo saying, it's not quite that bad, chaps, because we saw a strong bounce on the day and we recovered to close around 115.25, marginally higher on the day. We open around 115.15 against the euro and the dollar this morning because euro dollar is bang on parity. Over in the US, some Fed members think US interest rates will rise to over 4% and remain there throughout next year in 2023. Many agree with Governor Bailey of how Russia's invasion of Ukraine has created price shocks that have hit goods, labour and commodities. But discussion continues over the size of the September rate hike from the Fed. The US trade deficit dropped to a 9-month low of $70.6 billion, which was down 12.6% from the previous month, largely due to dollar strength making imports cheaper. And indeed, the dollar index continued to rally yesterday. We saw a high of 110.70 before a bout of profit taking saw that pull back to close around 109.55 on the day. So plenty going on, plenty to keep an eye on, and do join me again tomorrow. All the best.
If you do not have a clue, then just tweet through and ask FxPlew.